Have you ever made an investment decision based on your emotions? Imagine a scenario where the stock market is in a free fall, and you find your heart racing with panic as you rush to sell off your stocks. Or perhaps you've seen everyone around you investing in a hot new trend, and you've jumped in without a second thought, simply because you didn't want to miss out. These are all classic examples of what we call emotional investing. Emotional investing is essentially when we let our feelings guide our investment decisions, rather than relying on solid facts, thorough research, or a well-thought-out financial plan. It's when we allow our hearts to rule our heads in matters of money, and it's an easy trap to fall into. After all, we're only human and our emotions often have a strong hold over us. But as we're about to see, this can often lead us down a risky path. There are several types of emotional investing, each with its own set of dangers. Let's start with panic selling. This is when investors, driven by fear and anxiety, sell off their assets at the first sign of market downturn. Then, there's the fear of missing out, or FOMO, where investors jump on the bandwagon of a trending investment without fully understanding it, simply because they don't want to be left out. Another common type is the herd mentality, where investors follow what others are doing, assuming that the majority must be right. And finally, there's overconfidence, where some investors, buoyed by past successes, start to believe that they can do no wrong, leading them to take unnecessary risks. So, as we can see, emotional investing can lead us to make impulsive and potentially damaging financial decisions. It's a slippery slope that can easily erode our hard-earned savings and derail our financial goals. And that's why it's so important for us to understand it, recognize it, and learn how to avoid it. As we delve deeper into this topic, we'll unearth some strategies to help us keep our emotions in check and make more informed and rational investment decisions. Stay tuned. Now that we understand what emotional investing is, let's delve into how it can negatively impact our finances. To kick things off, let's consider the classic investing misstep: buying high and selling low. Suppose you've heard about a particular stock skyrocketing in value. Seduced by the hype, you decide to jump on the bandwagon, buying the stock at its peak. Unfortunately, the market corrects itself, the stock's value plummets, and you're left with a significant loss. This is a classic example of how emotional investing can lead to buying high and selling low, a scenario that can severely dent your financial portfolio. Next, let's talk about missed opportunities. Emotional investors often become overly attached to specific stocks or sectors. They fail to diversify their portfolio, missing out on potential gains from other investment avenues. For instance, an investor might become sentimentally attached to the tech sector, ignoring emerging opportunities in green energy. Over time, this lack of diversification can result in lower returns and increased risk. Finally, the most damaging impact of emotional investing: the possibility of losing money. Investing should be a long-term game, but emotional investors often make rash decisions based on short-term market fluctuations. They panic when the market dips and sell their investments, only to see the market recover soon after. This reactionary behavior can lead to substantial financial loss. To bring this to life, imagine you're on a roller coaster. It's a thrilling ride with highs and lows. Emotional investing is like getting off the roller coaster during a dip because you're scared, only to watch it climb to new heights from the sidelines. The roller coaster ride, like the financial market, is designed to reach greater heights over time. By reacting to the dips, you miss out on the highs. Clearly, emotional investing can have severe consequences on our financial health. But don't fret. In the next scene, we'll discuss strategies to help you avoid falling into the emotional investing trap. Stay tuned. So how can we prevent ourselves from falling into the trap of emotional investing? Well, the first step is to have a structured investment plan. This is a roadmap that outlines your financial goals, risk tolerance, and timeline for achieving these goals. It's a blueprint that helps you stay on track and prevents you from making impulsive decisions based on temporary market fluctuations or emotional triggers. Next, it's crucial to do thorough research before making any investment decisions. Understand the company or asset you're investing in. Look at its historical performance, financial health, and future prospects. This will equip you with the necessary knowledge to make an informed decision rather than an emotional one. Diversifying your investments is another key strategy. By spreading your investments across different asset classes and sectors, you reduce the risk of substantial losses if one investment performs poorly. This not only protects your portfolio but also reduces the emotional stress associated with investing in a single, volatile asset. Seeking professional advice can also be beneficial, particularly if you're new to investing or find it challenging to separate your emotions from your investment decisions. Financial advisors can provide objective advice, help you understand the risks and rewards associated with different investments, and guide you in making decisions that align with your financial goals. Finally, commit to ongoing financial education. The more you understand about investing, the markets, and financial management, the more confident you'll be in making rational investment decisions. Read books, take online courses, listen to podcasts, join investment clubs. Learning is a never-ending process, and the more informed you are, the less likely you are to make decisions based on emotions. In conclusion, emotional investing can be a significant pitfall for investors. However, by having a structured investment plan, doing proper research, diversifying your investments, seeking professional advice, and committing to regular financial education, you can navigate the investment landscape more rationally and less emotionally. By following these strategies, we can make investment decisions that are more rational and less driven by emotions. Let's recap what we've learned today. Emotional investing is when we let our feelings dictate our financial decisions, which can often lead to detrimental effects on our financial health. It's like going grocery shopping when you're hungry. You end up buying a lot more than you need, and often items that aren't good for you. We've discussed the pitfalls of emotional investing, including the potential for significant financial loss and the stress that can come with it. It's a slippery slope that can quickly turn a sound investment strategy into a game of chance. To avoid falling into this trap, we've explored strategies such as creating and sticking to an investment plan, diversifying your portfolio, and seeking advice from financial experts. Remember, the goal of investing is to build wealth over time, not to get rich quick. If you found this video helpful and interesting, please hit the like button. And don't forget to follow and subscribe for more empowering financial content. Together, we can make smarter financial decisions and achieve financial freedom.